When it comes to trading candlesticks, they are going to be probably the most useful tool that you can use when it comes to technical analysis, because what it's showing you is what's happening right at that moment. It's not a lagging indicator in any way, such as moving averages or most oscillators. It's not a predictive indicator either. It's showing you whatever the price action is at that very moment. So it is a vital element when it comes to financial markets to learn everything that you can when it comes to reading candlesticks and what they mean. So in this video, what we're going to take a look at and concentrate on is what the wicks mean, what the bodies mean, and then how the different sizes of the bodies can mean certain things for the volatility or for the trend. And then we're also going to look at how we can actually trade and take positions using candlesticks and where we can look for strength and weakness in the market. So we'll get going first with the wicks, also known as the shadows. The wicks are just showing us what the extremes are for that market at specific time intervals. So if we look at this chart, we can see here on the left that there's a couple wicks here to the downside, okay, before an uptrend occurs. And then we have a really big wick over here. Essentially, what this is telling us is that the price has actually dropped to specific levels here, according to the wick. But the selling pressure was not strong enough, and the buyers came back and stepped in, pushing the price back up. So we can see at this point that there is a high demand for the asset, a higher than average demand. As soon as price moves within that demand area or support zone again, we see additional buying pressure. Now, if we look at this candle, we can see that it wicked down quite significantly in a single day, dropping all the way to about $64 and then coming right back up to $68. So this is crude oil futures on the daily chart. That's a huge swing in a single day. And it's telling us again that there is a high amount of demand at this specific price level. And even if we move to the right of the chart here, you can see that every time price attempts to move back down into that wick, we get an additional amount of demand and buying pressure step in. So that's why wicks can be extremely useful when reading price action. If at any point you see wicks form at specific prices, just imagine that there tends to be a high amount of buying stepping in over there. We can see even over here, it's not as obvious as this point, but over here you can see that there are still wicks to the top side. It's just telling us that every time the buyers attempt to push the price higher, they're unsuccessful in doing so, and thus the sellers step in, constantly selling it at a higher price until eventually the buyers can't hold the price up any longer and we get a fall. When it comes to looking at them in confirmed trends, candlestick wicks can be great ways to enter into positions. We can see an example right there, and we can see another example there. They kind of stick out very obviously. When we see a retracement, okay, which we see over here, we see the price retrace up, forms a wick, and then we get an entry candle in the form of this inverted hammer, as well as the inverted hammer there. What's really nice about finding candlesticks in trends like this too is that if you take an entry there, you can easily place a stop right above that wick, because as the price attempts to move back up past that wick, there's going to be additional selling pressure. And that's just giving you extra expectancy and probabilities on your side of the position. The next thing that we can look at when it comes to candlesticks is we can look at the size of the actual bodies and the general size of the candlestick itself too. When it comes to a range-bound market, we are going to see candlesticks that have varied sizes. Okay, so a really good example is right here, where we see a large amount or large number of candles. We've got a big red one there, big red one there, and then we've got a bunch of small ones all over the place. It's just telling us that there's indecision in the market. There's no trend. We can also see volatile candlesticks and different sizes in a actual confirmed trend, but this is also telling us that the trend is not in a smooth motion, and that's okay. We can find entries in those specific trends, but if it's far better if we can find a trend where the candlesticks are of consistent size, because then we have more of a consistent trend. And if it's more consistent, we can be able to predict price movements a lot easier. A good example of that is right here. You can see that in this specific area, we've got the candles that are very much of similar size the whole way through. this is showing us that the trend is more predictable than one that is quite volatile with different candlestick patterns and sizes. So these are the two main factors that you should consider when you're trading candlesticks. Basically, when it comes to the wicks, whenever you see a whole bunch of wicks forming at a specific price level, it's just showing you that there's a higher demand, in this case, a higher demand for the asset. So it's going to be forming a support zone. So you can mark these support zones off, and then every time price moves in there, you can begin looking to enter into long positions. Again, with the candlestick sizes, if you're looking to trend trade, it's better if you see candlesticks that have a consistent size compared to a varied size.